afternoon. Welcome to Financing and Funding Your Business. Today's speakers are going to be Bret Strong and Brian Albert with the Strong Firm. Bret is the founder and managing shareholder of the Strong Firm PC, which was formed in 2004. He has been a resident and an active community leader in the Woodlands, Texas for over 30 years. Bret spent 11 years with Shell Oil Company in areas of contracting, finance, and information services prior to becoming a license in the legal field and establishing his practice in the Woodlands in 1996. Bret is a 2014 Interfaith Hometown Hero and has served on the boards of dozens of organizations throughout our community. Brian joined the Strong Firm in 2012, and his practice focuses on the firm's corporate, real estate, and business transactions practice groups. Having previously worked for multiple Fortune 500 companies in various fields, Brian uses his skills and experience in representing clients in a variety of business transactions and counseling on general corporate and other business matters. His practice involves a wide range of transactions, including the representation of strategic investors, private equity groups, private and public corporations, nonprofit organizations, and other entities in connection with mergers and acquisitions, private debt and equity securities, purchase and sale of assets, financing real estate transactions, and other commercial transactions, including drafting and negotiating contracts for various matters. Welcome, Brian.
Kristen, Brian and I are going to split this up. I'm going to do the front end, he's going to do the back end of this. Like any good lawyer, we have disclaimers that say whatever we tell you, you can't rely on it at all. That's all nonsense. So go hire your own attorney. We'll talk a little bit about that. So background wise, you kind of heard what Brian and I do. And our firm, just to give you a little background, has practices in 7 general areas. But the best way to describe our firm is a business boutique firm. We all live here, have deep involvement in the community, and we're a firm that people come to for, I guess, high-touch business type transactions and some litigation. So you saw the backgrounds. We won't bore you with all of that. So what we're here to talk about today, and listen, I am fully aware that it's 2:30 in the afternoon on a Friday, the most beautiful day we've had in 2021. So we're not going to keep you here probably as long as others. But for those of you who are watching online, you can probably set your timer. We'll get through this probably about a half hour or so and get you out of here. So what we want to talk about today is how you finance a business. And you can't talk about financing a business unless you talk about how you structure the business going into financing it. Because you think about how the basics of accounting work. You set up a business. There's the balance sheet. You got the assets is where you start to build value. You have liabilities that offset that, and you have equity. And we're going to talk a little bit about those things and how it is you finance a business. So the structure of a business is very important because it does help dictate risk, how you share money in and out of the company, or share money out, how you get money in. So it's important to talk about that. And I was just in a very good CPA's presentation about structure where she went into a little bit more detail of this. But really, for our purposes, we want to talk about how businesses come to us, or if the ideas come to us, how we have a discussion about starting up the structure so that you can get money into and hopefully out of the business. It really lays down into these 5 areas. There's a sole proprietorship. A lot of businesses start with a sole proprietorship. Basically, they have an idea. They open a restaurant, they open a yoga studio, they do whatever it is they're going to do, and they just do it. And that is perfectly legal, perfectly fine, and it's typically how people get started. The issue from a lawyer's perspective on sole proprietorship is that it has no legal distinction, which means it has no legal protection. So if I am Joe's Barbecue and I've got a barbecue trailer, I pull up at a food truck every day, and somebody eats some bad food and sues me, or I run them over as I'm pulling my truck in and out, that personal liability can go to you immediately, personally to you, versus if you have an entity that protects you from that. So, but sole proprietors can take in investments and have partners and do all that sort of stuff, just like anybody else does. So, and we'll talk about general partnerships along those lines. So corporations, most people, small businesses, if they are a corporation, become an S corporation. That's a tax distinction. Basically what it is, it's the filing you do with the IRS. that allows you not to be double taxed. If you are a C Corp, if you're IBM, that's a C Corp, although even a lot of the big corps now are becoming partnerships. Let's say IBM is a corporation. When you get a dividend from IBM, you have to pay taxes on that. And it's the same thing if you're a C Corp, if you start a small business. And that is that the money that you get out of the company gets taxed and the corporation pays tax. So you're really paying double tax. Versus an S Corp allows you to not pay tax on the money from the corporation level, but you pay it when it comes out. And that's the advantage of that. Once again, important when you start talking about how you get money in and out of the company. Limited liability companies have probably become the most popular form of structure because they're flexible. They were created back, just started back when I was in law school. So that means that was a long time ago. It used to be, they were relatively new, but they were talking about the 90s. We've had LLC since then. And they're really a corporate structure boiled down to a basic, a real basic structure that doesn't have all the formalities of a corporation. You don't have to have board of directors. You don't have to have officers. You basically can have members, which are the owners. And if you want, you can have managers who are the people who manage the corporation. It's really that simple. From a tax perspective, which makes it even more attractive, is you can be a partnership. You can be an S corporation. You could be an LLC and be a C Corp if that's what you want to do. It's a check the box type of an entity. So it's probably the most popular, I'd say, in the businesses we set up. On Eric, you probably know that does this as well. When we set up businesses, I'll bet 90% of the entities we do are LLCs. General partnerships. So you always got to have this thing that is nebulous, but is important. If Stephen Wright and I decide tomorrow, you know what, we're going to start a new business, which is providing really good internet services to community colleges. and so we just say, hey, I'm going to be the guy that does the wiring, and Stephen, you're going to be the guy that gets the routers. And when we create this partnership, we instantly have created what they call a common law partnership. And it's a partnership for common law purposes. Here's the problem with the common law partnership, and that is I'm liable for all the stupid stuff Stephen does, and Stephen's liable for all the stupid stuff I do. And that's why people really don't like general law partnerships. So, and when you think about how money comes in and out of companies, we're talking about today, that is, we got to have an agreement how that works. A lot of people just start these partnerships and don't have those agreements. And then next thing you know, we're 2 or 3 years down the road, we're either losing a lot of money, so we're mad at each other, or we're making a lot of money, we're trying to figure out how we're going to take it from each other. And those are the fights that Kristen, who's here, makes in our law firm. That's what she does a lot of, partnership disputes. People who are mad at each other because they didn't figure out on the front end how to do a partnership. So you have the final item, which is a limited partnership. That is something that is an entity created under law that you create limited partners, and those limited partners don't have liability to each other or the other partnership. And you have a general partner that has that liability. So it separates the types of people in the partnership. So in all of these entities, there are distinct ways money gets in and out, but there is a general approach to getting money that is applicable to all of these. So let's go through that. So there's 3 basic ways money comes into a business. We're talking about how it comes in, right? Earnings. And that is, I can tell you, most businesses just start and all the money they have coming in is whatever they make. And that's how they fund their business. Typical, very common way to fund a business. And so you can't just pass that up. But how are the other ways that the ways that are probably more or less conventional, but very common, that money gets into a company? That's borrowing, right? You go out and borrow. You go to a bank, you go to a private institution, you issue bonds. There's all sorts of things you can do. But most people, once they ask all their friends and family and everybody else for money, they won't give them to it. They go to a bank, right, with a business plan, and they say, I want to borrow money, and here's why. So the third way is capital investment. It's that asking people for money, either formally or informally. And most of the time we see in our business, for small businesses, a lot of times it's informal. It's, hey, my aunt has money and she wants to invest in my business, or family or friends. And so that's kind of what you do. So if you start a company and you say, I want to bring more money in, you sell existing or additional ownership stakes in that business. And that's how you end up with shareholders if you're a company, if you're a corporation, members if you're an LLC, partners if you're a limited partnership. So let's talk about those 3 areas. We start with earning, funding from earning, the old-fashioned way. Like I said, that is generally how people grow and bring money in. And that is basically that, you've got retained earnings being being the beginning period retained earnings plus the revenue minus expenses. In other words, what you have left over. And sometimes it's a loss. So sometimes money's going the opposite direction. You're creating less than retained earnings. But that's the whole equation. You can't see up there behind the video, but dividends or distributions are really what's you got left over. So when you're done at the end of the year, if you're a sub-S, this is very common, sub-S corporation, I say you have $1 million in revenue, you have $900,000 in income, you have $100,000 in money left over, you got to figure out at the end of the year, what am I going to do with that 100,000? Am I going to take it all out? Which means you're not putting any money in the business. And I'm going to take 50 out, put 50 back in, you got to account for taxes, but we won't get into all that. Or are we going to just roll that 100,000 back in? And that's generally, I will tell you how most small businesses get started and grow. It's the most basic, it's the most basic source of funds because the goal of business is generate profit. Generate profit, you hopefully are growing your business, and that's most common. Retained is historical profits not paid out, as we talked about. Business keeps the profits in to be used for other purposes, and is decreased by future losses. So you're in fluid. So that means you got to think about, okay, next year might not be a good year. I'll tell you, people going into COVID that weren't very cash solid, that had things like if you were a restaurant, that all of a sudden business went from 100% to 0%. If you did not have a line of credit, a lot of cash on hand, or someone who was going to fund you before PPP loans were processed, you were in big trouble very quickly, and we saw a lot of that. So funding from earnings, the old-fashioned way, as I said, what are the pros of that? It's uncomplicated. You just budget every year, and you say, I'm going to make $100,000. I'm going to roll that back into the business. I'm going to grow revenue next year, and over the next 5 years, I'm not going to have to borrow any money, and I'm going to grow my business. No added cost beyond the built-in operating expenses. In other words, you're not paying yourself interest. You're not having to give up a portion of your company to someone in exchange for them putting money in. I have to value it, figure out what is 10% of my company worth, and try and sell that to somebody. It's very, very uncomplicated. No added cost. Assuming profit amount, timing, and discretion of management. It is risky from that perspective, which means if you need money, you say, I need to buy, say you make widgets, you need to buy another widget maker. It's hard to predict profitability so that you know when you're going to be able to buy the other widget maker. Versus I can just go out and borrow money, buy a widget maker, and then I've already got that capacity. So it is, from that standpoint, it is timing and discretion becomes an issue. Liquid, readily deployable cash, you have it. If it's in your bank account, you have it. You don't have to count on the bank. You don't have to count on what the interest rate is going to be. You don't have to count on drawing against it. So from the reliability, it's that are the pros. Unrestricted use, unless they're subject to governing documents. In other words, if you have that money in the company, if no one else, none of your partners or anyone who's an equity player, and you don't have a bank, that's just all equity players. If it says I can do whatever I want with my money, you can do whatever you want with retained earnings. So that's why it's probably from the pros has lots of pros. What are the cons? Requires or assumes continuously profitable operations, and that's what gets businesses a lot of times. There's bumps in the road, unanticipated expenses, and then you don't have this line of credit, or you don't have the cash from business, so you can't grow. Requires operations. In other words, it's hard to fund right up front a business with retained earnings because you don't have retained earnings, right? So it means you have to build some cash to start, and there's no startup funding for you like with a line of credit or an investor. Losses negate the source of funds. You lose money, the funds go away, and so that then instantly takes away your ability to grow. It's unpredictable, as we talked about, and it's limited amounts. You can only fund retained earnings as fast as you grow revenue or cut expenses, whatever the bottom line is. So it does limit you because it's limited in amounts. Yes. I would say, it could cause disgruntled owners. Yeah. So we see this a lot as well. If we got one person running a business and they're the person who basically is making all the decisions about what are we going to sell, we're going to increase, we're going to open another restaurant, we're going to do all this. You've got other investors that are in there that just, once again, take away the fact you're not borrowing money or raising money at that point. You can have real disgruntled investors if in fact, all you're looking at is earnings to keep the cash flow going to grow for that next restaurant. And we see this a lot, by the way, of where here was the pro forma, as they call it. Here's what we projected when we got started, and we didn't hit that pro forma. Why not? Well, you made stupid decisions running the business, or you invested in something you shouldn't have invested in. And so if your only source of funding is the retained earnings, it can cause some real grief. Versus if you're sitting with $1 million line of credit, you're a guy running the company, you say, I have $400,000 of line of credit, and I'm going to increase sales and I can pay that down, and my investors will be okay. If it's the only source, it can cause some real problems. All right, so Brian does a lot of our work related to banking and lending and all of that. So I'm going to hand this over to him to talk about the other ways that we bring money in that are more complicated too. I'm just a pretty face, everybody knows that. So when it gets real complicated, like loans and that sort of thing, I bring in Brian that knows what he's doing. So I think you got a microphone and you can go from there.
Yeah, that works. So kind of like Bret said, obviously retained earnings, that's the old school way. I mean, you don't have to go to an outside source to get those funds. But like a lot of businesses, either because you run into an issue and you need money, or you want to grow and you need some additional capital to invest into the business, you either don't want to use the retained earnings, don't have enough of them. That's when you go to these secondary sources, or at least you consider them. Most businesses are going to look at the borrowing side. That's the thing that pops into most people's minds. I have a business, I need some money, I'm going to call the bank. So you can break down borrowing really into three different categories. The first one's commercial loans. That is what we're talking about, traditional banking, where you go to a financial institution, you say, I'd like to borrow X dollars. And in typical commercial lending, they're going to have a whole set of terms. You're going to talk about, well, how much are you borrowing? What's the interest rate? What's the term of repayment? What's the type of facility? And by facility, I mean, is it a line of credit where you pay it off month to month as you draw from it? Is it a term loan where you get all the money up front, you pay it back in 5 years, 10 years? Is it secured? Most commercial financing is going to require some form of security. They're not really just giving away unsecured, risk-free dollars, because they assume, hey, you're a business, you've got something worthwhile to protect us in the event you can't pay us back. So that's where you're going to get into security. A lot of times that's going to be the assets of the business. If you have real estate, it'll likely cover that, or it might be a personal guarantee. Bret touched on the different types of entities that you can use when you start up a business. Well, that still doesn't get in the way of you also still being personally liable when it comes to commercial financing. Because the banks say, hey, your business is great, but if that all goes away in the next year, I still have to know that someone is going to pay me back. And usually that someone is you, or you and your partners, or someone else involved. A lot of commercial loans have what we consider borrower obligations. These are financial and control covenants. So things like you've got to keep X amount of dollars in your bank account during the life of the loan. You can't change control of your management structure. You can't move your business location without letting us know. There's actually a lot of them. If you ever look at a commercial loan agreement, it's a lot of pages, usually talking about all the things you can't do, or if you're going to do them, how you can go about doing them. Unlike retained earnings, where you can control what you're going to do with those funds, the use of those funds is usually restricted. Usually you go to a bank and say, I need money. They say, okay, for what? Is it a capital acquisition? Are you buying a piece of equipment? Are you purchasing a new building? Is it just working capital? The type of use that you have in mind is largely going to dictate the type of facility and the type of terms that you get. And then lastly, fees and underwriting. As you would expect when you're dealing with a bank, there's a process. The bigger the bank, the more of a process. Luckily, we live here in a business community that has a lot of local and regional banks, which tend to be a little bit more flexible, but they still go through the same process of determining, well, are you a good enough credit risk for us to be willing to lend you money? And the underwriting process evaluates your financials, your business operations. If you do have secured assets, they sometimes will inspect them, they'll get appraisals on them, and then they'll assign fees. That is also kind of a hidden issue that some business owners don't realize until they go into that first loan application, where they say, well, I'm borrowing, $1 million. I'm going to pay you back with 6% interest. And oh, by the way, the bank is also going to charge you a lump sum fee to close that transaction. So it's the cost of borrowing And sometimes people aren't ready for that when they first go into a loan transaction. So separate from commercial loans where you're dealing with a wood forest, there are private loans, and there are people and groups that are non-financial institutions that are in the business of doing loans. Now, that also might be your rich uncle who's willing to lend you some money to get the business going or to keep you afloat. But there are some people, especially in this town, that are just have a lot of money. They're willing to give it out to you because they know if they know you, they know the business, it's relatively low risk, and they're going to get a little bit of money on it. As long as they can make more, or it's safer of an investment on you than it is to throw it into the market or some other form of securities, that's an option for them. So just like with commercial loans, you're still going to have all the same type of terms, talking about the principal amount, the term of the loan, the rate of interest. But usually you're going to get a little flexibility. For one, security and collateral might look a little different. The banks don't know you. Usually if you're dealing with a private loan, it's someone that you have some sort of relationship with. So they either might not require security, or if they do, it might be something more specific like equity. Hey, I'm gonna give a loan, me personally, Brian Albert, to Steve's business, and I'm gonna say, well, I don't want all your assets. I don't want to run an IT company. I just want to own it. And so I just want your equity in the event you default on that loan. It's not going to be as restricted. It's usually an easier underwriting process because it might be the decision of a single person making that loan. I might just say, hey, I know you, I trust you. That's my underwriting. That's good enough for me. And it's generally not as expensive. Usually there might be somewhat of a processing fee, something that they just want to make sure they get a little bit of extra coverage on from you in the terms of dollars to make the loan. But a lot of times not. A lot of times it's just they've come to terms with whatever the principal and the interest over the term of loan is going to pay them, and that's the investment decision. But the flip side to that is usually a private loan is going to have worse terms, and by worse I mean higher interest rate, shorter term, because if it's me individually, I don't have the backing of my commercial portfolio of loans. One default for wood forest doesn't make or break them. If I give a personal loan and you default, that's going to hurt me more. So I want that to be a little bit riskier for you as the borrower, because I'm taking more risk as the lender. So usually you're going to pay a little bit more for that. And the last one, and this is just something that you might see within the realm of private lending, usually at the higher, more sophisticated level, are concepts like equity conversion or PIK interest, beyond the scope of today's presentation. But the idea being that I might be asking for a little bit more than your standard commercial lender would in the event of default, or a more hybrid approach to the repayment of that loan. And the third category of borrowing is debt issuance. Now, you're not going to really see that a whole lot in the small business world, simply because there isn't a market. So by debt issuance, we mean the sale of corporate bonds. So a bond, just like you probably hear that in the stock market world, or like government bonds, it's the same idea. It's essentially a loan that's of a fixed payment plan where you have a coupon. You're gonna buy this bond for $100,000, and every month I'm going to pay you X. And by the end of it, we're all even. It's similar to a loan, but it's treated differently from a financial perspective. Again, public companies often do this where they sell it out in the capital markets because there's a ready market. People are willing and able to buy it. You're able to get that out there to a larger group of potential buyers. If you as a small business likely don't have people that are even going to know about the fact that you're issuing a bond. So unless you have a market maker and you have an ability to create that, it's probably not going to come up. But it's the same idea again. Interest is payable as a coupon at an agreed rate with intervals. There's a par value, which is really the principal repayment. And those can be anywhere from 1 year to 100 years. Again, like government bonds, you'll see it often where it's a long-term play. And the reason people do it is because it's usually less risk than a loan or a note, where there's a higher chance of default. And then again, I kind of said that it may be convertible, it's unrestricted use of funds. Again, a little bit beyond the scope of today, but those are things you might see if you ever get into the private equity world where you're looking at bonds as an opportunity to fund your business. And then some other thoughts, just to kind of close the loop on borrowing. Again, at the end of the day, borrowing boils down to very simply that there's principal and there's interest. And that's the idea of any kind of concept of you're going to give me some money for a future return of it. It's not going to be for free. That's where the interest comes into play. There are plenty of things that I didn't touch on within that from a hybrid approach. There's a lot of creative and complex transactions out there to help finance, especially on the private side. And again, you might not get into that too much as a small business. Usually you're going to be looking at more of that commercial financing. Defaults, it's a big decision to take on debt. A lot of businesses, as a matter of principle, don't take on debt for the very reason that they're afraid. They'd rather fail because their operations failed than to fail because they couldn't make their debt payment and then the bank forecloses on their assets. So if you are going to go that route, which a lot of companies do, just understand that it's a real obligation and it can sink your business because those debt payments don't stop. And especially when times are good for banks, they're not as willing to work with you. When times are slim, then you might get a little bit more flexibility, but ultimately they're going to come for you and they always want their money back. There are some accounting and tax considerations when it comes to financing. There are some tax advantages in terms of the ability to deduct interest payments for your business or for you individually if you're a sole proprietor. And then always keep in mind, once you have debt, you can refinance or you potentially can refinance it. A lot of businesses go into financing with that in mind, knowing, all right, I've got to qualify, get whatever loan I can right now. It's a 5-year note, but by year 3, I'm going to be in a better position. I'm going to look to refinance it then. It's a little bit more of a sophisticated strategy, but it is something to keep in mind that a lot of banks are willing to take a look at an existing debt, essentially acquire that debt from whoever the first borrower was and give you new terms, new life on that debt obligation. And then the third big picture category we're talking about today is the equity side. So funding from capital investment. Bret gave a quick mention of that at the beginning, but the idea here is that you are in effect selling part of your ownership. So the ownership value in your business, whatever value there is, when you have your assets, you take away the liabilities, that's what's left. Now there's always some intrinsic value based on goodwill and other things, but the idea is that if you've been in operation, you have something, or if you're a startup, you have the promise of something that's going to come. And so that's what you're going to be selling. We often see this in the startup phase where someone's saying, I've got this great business idea, I just don't have any money. So you say, all right, well, you better go find a business partner to bring in with this. So now you're going from me being 100% owner to me selling part of my interest to a partner so I can get their money to come in. So even though we're now partners and it might seem like we're going into this together, really what I did was I just brought in new money. And so I went from maybe what would have been a sole proprietor or a single member LLC to now having a partner within this. And in exchange for their money coming in, I'm giving them ownership interest. That's really what equity funding is at its simplest form. There are no interest payments. There are no guaranteed returns. That's a pretty big part of this. So from the borrower or the person that's giving side, I'm saying, well, this is great because I don't have to take on new obligations. From the investor side, I have to be sure that this is something worth investing in because there's no interest, because there's no guarantee of return. I might invest in this business idea for $100,000 and I might never see a penny from that. And that's something that as the person giving the funds, you have to be comfortable with. I always like to touch on this, but a lot of people will call us and they'll ask questions about securities. Well, hey, me and my buddy want to get into a business. We're thinking about bringing in a third partner. Like that doesn't involve securities law. We don't have to do any of that. And the reality is any exchange of equity is essentially a security within the realm of the federal securities laws and state laws. It doesn't usually affect small businesses because there's a series of exemptions that come into play to avoid having to register with the SEC or with the state and become a public company in that sense. But it is an important distinction to call out because it does affect also who you can take money from and how you do it. Again, it's a little bit beyond the scope of today, but there are certain obligations you have as the issuer of the equity, the seller of the equity, depending on who you're selling to. We're talking about friends and family here. So that's the idea of it's a known commodity. It's a known person. You already have a relationship with them. You're essentially saying, hey, come be a partner with me. Usually the SEC the securities laws are going to look at that and say, all right, that's exempt because it's already an existing thing, as if you were just saying, hey, Brett and I, let's be partners. But you can run into an issue where, hey, maybe it's not my direct family member, but it's, you know, my cousin's friend. They heard about it at dinner, they want to get involved. You potentially are walking into a public solicitation at that point. And that's where you, if you've ever heard the term accredited investor, that's where that comes into play, where depending on the financial sophistication and wealth of that individual, you might have to do some extra steps to ensure that you're in compliance with securities laws. Again, a lot more to that side of things, but anytime you're talking about equity, you do have to think about that. And usually that's going to be more of an issue when you're, you know, especially if you're mid-life cycle of your business, you're saying we need more money and we want to bring in an outside investor in. Usually that's not going to come from someone you already know. You're probably looking to a new partner to bring in, and you gotta go through, you know, making sure that you're in compliance with everything there. So some pros of it, like I said, it's attractive to the investor. You know, if I'm sitting here with a bunch of money, I can say I can either loan you $100,000 and have a set fixed amount of interest that I'm going to get back plus my principal. I say, okay, that sounds fine. I can do the math, figure out what that is. If I have $100,000 to invest in your business and I really believe in what this is, and this thing could take off, and I could now be a 50%, 49% owner in something that could not just pay me back for the next 20 years, but ultimately give me an exit on the end where I also get to cash that out. Well, that's even better if it works. And so you can have a lot of investor traction. Early funding, depending on the type of business you are, the type of relationships you have, you might not necessarily have to have any sort of proof of success. When you go to a bank, if you're a startup, they're going to be pretty limited in what they're willing to give you, how they're going to give it to you, if at all. If you are selling equity for the same reason why it's attractive, you might be able to get someone willing to come in on the front end, take some risk with you for the chance of some higher upside. Control, you can issue these terms usually based on what you want. You're the one putting it out there. You're the issuer, so you can kind of dictate what that's going to look like. Now, they can always come back and say, well, if I'm going to give you this money, this is how I want it to be. But at least initially, you're dictating the terms and the capital value. Theoretically, it's unlimited, meaning if you really have some golden idea, you can tell people all you want, this thing's going to be worth, you know, $1 billion. You know, they can't necessarily prove you wrong necessarily. So if there's some way to back that up and get someone to buy in, you can really bring in a lot of money based on your promises of what it could be. So some cons. Number one, dilution, right? So it's my business idea. I'm going to make this thing be amazing, $1 billion company. The second I give equity out, I'm diluting myself. I'm giving some of that up, some of that $1 billion upside up to someone else. And so you really have to be willing to make that decision because if it's your idea, sometimes there's a little bit of seller's remorse where you say, well, you know, I really wish I had held on to that because now, you know, this thing took off. It really did do what I thought it was going to do. And now someone else is sharing in it. Voting control. Most people, especially for startup funding, are going to say, yeah, I'll invest in your business, but I want a control right, or I at least want to vote or a seat at the table so that you're not just calling all the shots and you took my money and I'm just hoping for the best. So that can be something that's tough to give up. Setup, it can be expensive and complicated depending on what your current structure is, kind of like what Bret was talking about at the beginning with the types of entity structures. It requires usually a lawyer and usually at least a CPA or accountant, a financial advisor to be involved in that. If you're a bigger organization, talking about a lot bigger dollars, then there's financial firms that are involved in those types of transactions. All those people require fees. And so that can become very expensive very quickly, even surpassing that which a bank's financing fee might be. Taxes, usually you're gonna have some limited tax advantages, and there's also tax complications. As an investor, I'm coming into it, I wanna know what's this gonna mean for me, for my personal taxes. Is it a taxable event? When's the first time I'm gonna have to pay tax on this potential gain or whatever dividends or distributions might come? So you have to take that into consideration. And the limited market, again, unless you're publicly traded, you don't necessarily have people ready and willing to invest money into your business. You might think you have the best idea in the world, but selling it to me, getting my money is going to take probably a little bit more than just your best wishes, versus being able to go public. And then you have literally the entire world of investors out there that are able to invest in your funds. So that can be a challenge. People might say, I want to issue equity, and there might not be anyone willing to buy your equity. And lastly, aggressive terms. I said that, as the issuer, you can kind of say, this is what I'm offering, and then they can say that's all well and good, but if I'm going to give you my money, this is what it's going to look like. I want a director seat. I want to limit your salary. I want to limit when you can make distributions. You can't sell the business without me consenting to it. All these things that maybe you were hoping to control, you might now be giving up on. And that's the downside of bringing in equity, because it's a new partner. So I know we kind of ran through that pretty quickly, like Bret said. The intent was really to try to hit on some of the high level ideas of really how to finance your business, more from the small business perspective, and understanding that there are options out there. It's not just go to the bank. But you really want to consider all the different facets of the options that we talked about here. So I know most of you guys know us, but happy to answer any questions you might have.
Yeah.
Can you talk, Bret, about here on the radio and even maybe late night television? You get this money, no guarantees required, start a company, get this free money or even grants. Can you speak to that? Does that stuff exist? Is it real?
Yeah, and so, just like anything else, it's been sold at night on TV. And I just wanted, as Brian was talking about, I started thinking about Shark Tank. It really, that equity part of it, the Shark Tank kind of boils that down to a real basic deal where they're all sitting there saying, I'll take 6% for 300,000. That's really what we're talking about here. So, there are two solicitations I've heard of, kind of like what you're talking about. One is there are people out there soliciting for investment in real estate stuff, and it's kind of, so they're out there trying to get people to invest. That's the one side of it. They have to be fairly real, because the SEC sees that and says, you got to meet certain requirements. I would be real leery about anybody who's out there saying, hey, free money, we're gonna give it to you, because as we all know as attorneys, those are the people we usually see about a year later say, hey, I found this free money, and now I got some Nigerian guy who scammed me out of $500,000. That's the sort of thing you see. So my guess is there is some of that is real, but I would be real skeptical about that sort of thing.
I guess I speak also like to the no guarantee here that say, form a company and you get a loan and it's only responsible for the company and there's no guarantee.
Yeah, no personal guarantee is what you're getting at. Yeah. You'll hear people say no recourse loans. You hear that all the time. I will tell you, it's very, very uncommon, unless you have established business, for you to not have to personally guarantee a loan. But there are, we do this for our clients all the time. When we say this is a pretty sure deal, and you're competing with banks for money, you can start saying, we want a no recourse loan. Now, they may say the interest rate's got to be a little higher, and I got to convince my bank committee that you're a good fit. But generally, if you've been established, you can get no recourse loans. But I doubt it on the radio is the best. They don't even know who you are at that point. How are they going to know whether they get no recourse, no guarantees? So, thank you. Yes.
I have two questions actually. One is, how would you categorize the Kickstarter? Is that, I kind of think of that almost like a social media version of Family and Friends.
Yeah.
Is that accurate?
Ish. Yeah. Crowdfunding became a thing, in the last few years. And there are some SEC exemptions now specific to crowdfunding. It can get pretty dicey, and a lot of like the Kickstarter, some of the online stuff probably skirts around some of the real rules on it, but it's hard to enforce compliance when you're talking about someone trying to raise $20,000 on the internet. But yeah, I mean, the general idea is, there are certain exemptions to securities registration requirements, but it usually, think of it this way, all securities they exist for consumer protection. That's really what it comes down to. They're saying, well, hey, if from the investor side, if there's people willing to give their money, the government's trying to protect them from getting scammed. That's at the bottom. That's really what it's about. So either the less risky it is to the consumer, or the more information's out there, and that's all SEC compliance really is disclosures.
Sure.
It's giving all the information so that that person can't possibly be getting scammed. Now, it might be a bad deal. You know, it doesn't have to be a good deal, but they at least have to know what the risks are. But that's the idea behind it.
Yeah, and to latch on to that, well, Brian, the practical side of that is the SEC's out there and they have limited resources, limited focus. They're going to be focused on people who are scamming people, first of all, to protect them. They're also going to look for bigger deals, right? So if you're out there raising $20,000, $100 at a time, and somebody loses $100, how motivated are they going to be to go to the SEC, hire an attorney, and do all that? So they're taking some calculated risk in doing those things and skirting around some of the laws. There are some exemptions, but there's also people who say, I'll take the risk. I'm going to make them a bunch of money if they lose $100 a profit. If I got 2,000 people who all put $100,000 or $100 in, how mad can they really be?
And it's also Kickstarter is also the idea is there's a product you're technically buying, right? You're buying a future product, right? Versus I'm investing into something with no guarantee of return of any kind.
Right, exactly.
And then my second question was just over the years, you've been around a long time. So over the years, have you seen a trend on especially startups versus the true, what I kind of consider the traditional growing for your own receipts versus the equity, partners and angel investors and all that? Have you seen that go one way or the other, fluctuate? Or?
Yeah, so you do. A lot of it is depending on the interest rate environment. In other words, what can you get alternatively for your money? How the stock market is doing. Right now, you'd say over the last probably 2 to 3 years, because interest rates are so low, there's so much cash available. There's a lot of cash out there available. You've seen a lot more equity plays in areas where you haven't seen in the past. We've got one good example is we've got a doctor's practice, and an optometrist practice in the Woodlands in the last year or so. You didn't used to see equity money be thrown at those sorts of things, right? Where all of a sudden an equity firm says, I'm buying pediatric practices and I'm going to give you this multiple of your earnings. And you're thinking, what is an equity firm doing buying a pediatric practice? What they're doing is they're going all over the state of Texas and saying, here's what I want. I want one that's been established for over 10 years. And I want these sorts of returns. And if you get that profile, they buy them all up. They run administratively at a high level. So they take all the billing and everything at a corporate level, and they squeeze the profits out of it, and they make a good return. And so getting to answering your question, yes, we're seeing a lot more equity play in areas that you've never seen from private investment firms, equity firms, family offices too. These families that have a bunch of money that they're trying to figure out, where do we place $100 million? They start looking at all these sorts of things. What used to be, well, you just put that in the stock market, buy a bunch of stock. They're doing all sorts of things. So over the years, I think you've seen more, especially the internet has helped, the ability to communicate and have information instantly, search and find backgrounds on people, and all that a lot easier. It's made the equity play, I think, a little more common. Brian,
Yeah, no, I agree with that. I mean, I think there's more opportunity than there ever was before. But also, interest rates are low. There's a lot of government help right now. A lot of businesses going SBA financing, which opens the doors to a lot of people getting loans that they probably used to not be able to get. So even though it's a tighter regulatory environment we're in from a financing perspective, there's also a lot of chances to do it.
Yeah, the banking crisis caused a lot of regulations in the banking industry. So especially the bigger banks. So if you go to a Wells Fargo or a BBVA, I can name off Kohler, you can call those. If you go to them for a small business loan or a smaller business loan, if you don't fit their niche, it's going to be very hard to get that loan. But here in the Woodlands, we have a lot of community banks that are mid-level banks that have private money in them, and their loan committee are people you know. Those banks, in my opinion, have tended to get a little more creative. And they also, because of SBA loans, PPP loans, and IDLE loans, and all the things that are out there, businesses that didn't used to be able to qualify. Of course, you're seeing that happen. It all has to do with risk, the environment, financial environment you're in, and then what the government's doing, printing money. Right now, the government's printing money. So. Any other questions? It is 3:15 on Friday afternoon. We appreciate the opportunity to speak at this for them. Hopefully there'll be decades of them more and we'll be back. So thank you to the chamber for all the hard work and local.